This is Evercore's Flow of Funds with Glenn Schorr. Sharp perspective on private markets, wealth, and the forces driving change.
Hi, everybody. Welcome to Evercore's Flow of Funds. I'm Glenn Schorr, and I'm very happy to have Lauren Basmadjian from Carlyle in studio with us today. Lauren is partner and global head of liquid credit within Carlyle's credit platform and has been an investor for a long time in all parts of credit. So the goal, I always like to tell you what the goal of today's session is. The goal of the session is to demystify CLOs. We're going to try to break down how they're structured, how the cash flows work, where risk and return are, who the investors are, and cover the full gamut. I got to tell you, in preparing for this conversation, I learned a lot, listened to some of your past podcasts. I think your head's going to hurt after today's conversation, but you all, I do hope that you come away knowing everything there is to know and then some about the CLO market. So with that, Lauren, thanks so much for doing this. We really appreciate it.
Thanks for having me.
Okay, maybe let's start a little bit with your background, what got you to this point, and maybe any high-level comments about Carlyle's business size scope.
Yeah, so this is my 25th year in CLOs. So I've been around for most of the industry's timeline. I started at a boutique asset management firm pretty much right out of college in 2001, doing CLOs. And then I've been at Carlyle now for 6 years, running the global liquid credit platform, which is predominantly CLOs. Today, Carlyle's liquid credit platform is about $50 billion. So we are the oldest piece of Carlyle credit. One of the largest pieces of Carlyle credit, and also one of the oldest and largest CLO managers in the industry.
Interesting. All right. Maybe a one or two high levels, like what advantages do you get by being part of the whole Carlyle family?
Yeah, so coming from a boutique asset manager, I actually didn't know what I was missing until getting to a large alternative manager that was encouraged to connect the dots within the firm. So there's an immense amount of knowledge within Carlyle, whether it be in our government affairs group, it could be in our capital markets team, it could be in private equity, direct lending, opportunistic, and being able to go talk to investment professionals and ask their opinions about industries and companies and management teams, and use that in your underwriting as well as your ongoing tracking of the credit. Because in liquid credit, we could sell anything any day, we could buy anything any day. So as the world changes, having a view and not sticking to your original thesis can really help. So having all the expertise within Carlyle, from PE to restructuring to government affairs, has been hugely helpful in managing the risk.
That's interesting. So does that go hand in hand with the data that's available at your fingertips? Maybe talk about that piece.
Yeah, our chief economist, Jason Thomas, puts out a piece every month, and he uses the portfolio data of all of the private equity companies. We don't see the names, but he categorizes it into geographies and industries. And with his data, he's able to predict things like inflation and GDP regionally. And when you look at the correlation, you look backwards on his data, and then when the official statistics come out, most of it's over 90% correlated. So it's almost like we're getting the official data before the official data comes out by using the information that Carlyle is getting from the portfolio companies.
I follow that. We're going to talk about active management and the state of credit when we get into it. Let's roll it back. We're going to start very much at the top. Some people aren't as familiar as others. How about describe a CLO and what role it plays in the overall credit landscape?
I think of a CLO as a mini bank, right? In a bank, you have deposits, and then the bank lends out money. Well, in a CLO, instead of deposits, we issue CUSIP bonds in the form of rated AAA all the way down to BB, and then an equity slice on the bottom, just like a bank will have equity on the bottom. And when we borrow that money or take that cash in, we use it to lend to below investment grade corporate credits. And these are big companies. The average EBITDA is $1 billion. So we're talking about really big, large, below investment grade companies. And it's an arbitrage product. So we're borrowing at a cheaper rate than what we're lending at.
When you say below investment grade, that is just strictly rating, capital structure. Maybe talk a little bit more about the underlying credits and the underlying companies?
Yeah, so the most of our credits are single B rated. There's some double Bs, and then there's some that migrate to triple C. But I'd say the most of the below investment grade loan market, liquid loan market today is in that single B category. And there's names that maybe you every day when you're using your products, you're not thinking that they're accessing CLO capital or they're below investment grade credits. But many of the airlines, for example, American Airlines, right, has a lot of loans in the BSL market that sit in CLOs. There's a lot of fast food companies that you may eat at every day that access our market for financing. It could be Arby's or Buffalo Wild Wings, or a lot of these companies come into our market. And then there's every other industry that you're going to think of, maybe companies that you're not as familiar with because they're not household names, but they're industrial, auto, technology, and healthcare companies that are accessing our market for loans.
Okay, so you talked about the underlying being single B, sometimes double B credits. But the tranches you mentioned going from AAA down all through the equity tranche. Maybe talk about the risk return as you slice and dice those cash flows into different risk groups.
So I think about, as from an investor standpoint, a CLO having something for almost any risk return profile. You have AAAs, which no one has ever lost $1 on. There's never been a default in a CLO AAA in its entire 27-year history, including through the financial crisis. What are you going to get paid for that? You're going to get paid a little bit more than a cash equivalent, right? So you're going to look at a SOFR rate and maybe get somewhere between 120 or 150 basis points over that. Very, very safe and stable. Then as you move down to double A's and single A's, you're starting to pick up an incremental spread for the incremental risk. That said, no double A or single A has defaulted either. So now we've worked through all of the A-rated bonds. None of them have ever defaulted in the CLO. Now you get to triple Bs and you're starting to pick up more spread, and then you're getting to the lowest rated piece of a CLO, which is the double B, where you're going to have more volatility, you're going to have more current yield, and you're going to have a better return, but you start to introduce a little bit of credit risk there. And when I say a little bit, if you look at CLO double Bs, the average loss ratio for a double B over the last 20-something years is 20 basis points. So it's actually not, it looks relatively safer than high yield or even BSLs. And the last piece is the riskiest piece. This is the equity piece. It's the last 10% of the CLO capital structure. And the equity gets all the residual cash flows after you take in your loan interest from American Airlines and the rest of the companies, and you pay your AAAs, your double A's, all the way down to your double B's. And whatever cash is left over goes to the equity. Now, the equity also takes the first loss of any default. So it has the most risk. But if you look at CLO equity historically, again, over a 25-year time period, you're going to get mid to high single cash on cash returns every year, and your average vintage IRR will be around 12%.
It's interesting. As I listened to you go through that, and that was excellent, I'm hearing for each ratings bucket, I'm getting a yield pickup over the cash equivalent and massive diversification. So I'm assuming some have some fear of some of the structures involved. Why don't we talk about how you think a CLO differs from other securitized products like RMBS or ABS?
I love that question because it's true. You look at CLOs and anywhere from any of the ratings classes, you're picking up more spread in a CLO tranche than you are for a similarly rated asset class somewhere else. And it is the highest spread for the rating that you're going to get in ABS, generally speaking, in the public market at least. Why is that? That should say that it's riskier, right? The default rate's not riskier. In fact, it's a better default rate than most of those other asset classes, but there's a lot of complexity. And I put this pickup and spread in two things. One is there's no standardized documentation in CLOs, so you need a lot more manpower and people to analyze each one of those documents, where in CMBS or ABS, they're standardized docs. They're actively managed portfolios. So you don't know what your portfolio is going to look like in a year or 2 years. That's why the manager matters so much, because it's not just a static pool of collateral that runs off. And then the last thing is it's not in the aggregate index. That may seem silly, but no one has to buy it for a benchmark, right? So you don't have a forced buyer. You have portfolios that change based on the manager, and you have no standardized docs. And I think those three are the biggest reasons that you're picking up more spread.
I get it. I cover some stocks that are not in certain indices, and people ignore them to their own peril. Not that you know anything about that. What about, let's talk about the implications for the manager, talk fees, talk anything else that we should be thinking about.
Yeah, so CLOs are generally generally have a 5-year reinvestment period, and then when you start to get prepayments, you're paying down your least expensive cost of capital, which is your AAAs, until the arbitrage just doesn't look that good anymore, and the equity decides to call a deal. So why do I say that for your question? Well, that means the average life of a CLO is about 7 years. So you could project out revenue streams for a CLO manager when they issue a CLO. On average, you're going to get those fees for 7 years, except resets have become really popular over the last 10, 12 years. And what does a reset do? A reset says we're going to open up the document. You still have all your collateral, all these loans in there, and we're going to give you a brand new reinvestment period. So if we just look at our data of Carlyle, about 2/3 of our deals get reset, which means that 7-year term turns into a 12-year term, generically speaking.
Who chooses reset?
The equity decides. So the majority of the equity has to instruct the manager to reset. And so I think when you look at, the implications for the manager is almost you have more upside on the management fee streams than what you originally signed up for. And our market is turning into, I'd say, more perpetual capital is not the right term because it's not forever, but it's longer capital.
It's interesting. And why does the equity owner want to do a reset?
Well, there's a bunch of different reasons. It depends on the environment you're in. Generally speaking, you're not going to find equity that wants to reset if the cost of capital of your debt is going to be wider than what they have, right? So in times like 2022 or 2023 after Ukraine, where spreads blew out, you didn't see a lot of resets, right? The resets sort of slowed down because the cost of capital would have went up. But when cost of capital starts coming down, equity investors have been trained just from a return perspective to lock that in the CLO structure. You get 12-year non-mark-to-market financing, and you hope that your asset spreads sometime in those 12 years go wider, right? And you have this great cost of financing.
Right.
So you'll see more resets at times when spreads on capital goes down. And then also, if you're going to be in the CLO market, calling a CLO and then issuing a new CLO has friction costs. You pay the underwriter, you pay the rating agencies, right? And so if you could reset a CLO and you think you'll get a similar return to buying a new CLO, a reset makes more sense.
I would imagine that they're probably not that scared about upcoming credit costs if they're resetting a CFO also. Okay, cool. How about the scalability of the business?
I think once you get to a critical mass, it's extremely scalable. When I look at managing our portfolios, we have between our U.S. and European business almost 100 CLOs. But when we buy a loan, we're spreading it across our CLOs. At least if there's no test that would be breached if that CLO bought it. Meaning some CLOs, as they get older, have weighted average life tests, and you can only buy short-dated loans. That's mostly what I'm talking about. But generally, we're managing across all the CLOs as one big pool. So if we look at a certain risk in investment committee and say, we view this as a 30 basis point risk, meaning that's the appropriate position for one CLO, that's what we're allocating across all of them.
A little known fact, I'm doing this job for the last 28 years. Before that, I managed some muni money. So I could have tripled or more my AUM and not worked 5 more minutes in the day. Talk to me about that from that standpoint.
Yeah, I mean, you're covering the credit, whether you're managing $5 billion or $50 billion. So it's extremely scalable. There's a cost to building a CLO manager. We have over 20 analysts in the US, or industry analysts, just for our liquid business, and over 10 in Europe. That costs a lot of money. We have a 6-person restructuring team that I think rivals any of the largest managers who probably have the most expertise there. So building the right team, which can be expensive, is hard for a new manager, right? To get that type of expertise and get the right people and the amount of people that you want. But again, once you start scaling that business and you get to size, bringing on the next CLO and the next CLO, you don't need to hire any incremental people.
Makes sense. One last thing in terms of CLO structure is the question is the role of the banks in all this.
Yeah, so we use banks to help structure our CLOs. So usually it's us or one of our equity investors that engages the bank and says, "All right, we want to do we want to issue a CLO with Carlyle being the manager." The bank will handle the modeling process, the rating agency process. They'll act as a conduit between us and our debt investors in negotiating all these steps in the docs that are non-standardized. It actually takes a lot of time. So that's why the banks get a fee. And I'd say most of the biggest banks that you would think of that you probably cover have a CLO underwriting or origination business.
And are you sourcing a lot of the credit through the whole
That's
bank
right.
community?
So we don't lend directly. We look at loans that the large banks are syndicating. We want to be able to be in the most liquid loans so we could express our view on changing credit risk by buying or selling. So most of these very large banks that have a CLO issuance desk also have a loan syndication desk. And they're showing us the supply of loans from LBOs and M&A activity that's going to come to the BSL market.
Okay, back to the tranches. Overgeneralization, but which types of investors like to sit in AAA, AA, who's more of a single B equity tranche owner?
Yeah, so just like the return is different at each one of those levels, the investor base is pretty different at each one of those levels. I'd say at the AAA level, we see a lot of bank demand because it has been so stable. They buy and hold. And that's U.S. banks as well as Japanese banks. So I'd say you see some insurance companies, but mostly banks that you would know buying AAAs. As you move to AAs and single A's, you see more insurance companies. Why? Because they generally get the same capital treatment on the AAs and single A's as they do on the AAAs, but they get paid more. So it's just a more efficient asset for them to buy than AAAs. So that then you move down to triple Bs. You'll still see some insurance companies buy triple Bs, but now you're starting to see some money managers and hedge funds start to come into that tranche. And then when you get to the double B, you have hedge funds, you have specialized funds, credit funds that are coming in to buy the riskier piece of that. Now, the equity. Traditionally, the equity would be purchased by, I'd say, CLO specialists. People have raised money to invest in the equity of CLOs. It's a highly complex product. And as well as hedge funds as well. I'd say that was a traditional base of equity. But over the really since risk retention came into play, so last 12 years, you started to see managers like us go out and raise captive equity funds. They were originally called risk retention funds, but then risk retention went away in the US, and managers were educated that there was a whole different investor base that they hadn't been talking to until they were forced to talk to them because of risk retention. And now you're seeing a lot more traditional buyers come in to CLO equity than ever before. And you think about pension funds, you think about sovereigns, family offices. It's really opened up the universe for CLO equity investors like it's never been before. No one knows exactly what % of the market is traditional CUSIP buyers, just buying one CLO at a time, versus this captive equity. But our estimate is now over 2/3 of the market.
Oh, wow. Maybe just a quick follow-up there is I would imagine if you're a manager that's in a scalable business, you'd love to double and triple your assets if the demand was out there. Explain the risk retention. I'm assuming that some people don't know what that means. And then importantly, if you were able to raise, is the equity tranche the limiting factor to how much you can grow?
Yes. So we'll start there. I'd say the equity tranche is what drives the CLO being issued. Collateral is easily sourced in the secondary market or the primary market. So at times when the secondary market's expensive, you wait longer because you buy more in the primary. At times when the secondary market is cheap, you could create a CLO really quickly. But really, and you'll be able to issue the debt, at least if you're a large manager with a debt following. So it's really about attracting the equity and having the equity work with the manager to issue a CLO. When I think about risk retention started basically because of the financial crisis. And the irony there is what it said that no AAA, no AA, no single A ever defaulted. Double Bs have less than a 20 basis point loss rate a year. And CLO equity, probably the best or second best vintage that ever existed, was CLO equity that was created right before the financial crisis, which meant it went through the highest defaults that we've ever seen as an industry. Why did that do so well? Just because the assets got really cheap and you had that long-term financing that stuck out there, right? And you were able to buy things cheap. So it performed as advertised, if not better. But as they were looking at rules about what created the financial crisis, which was mortgages, not corporate credit, CLOs sort of got tagged. And the irony is mortgages didn't. I think maybe there was some lobbying there. But what ended up happening is the rules came into place and said, all right, CLO manager, you have to have skin in the game. You need to take 5% of every CLO that you're doing, either in the form of a vertical slice or all equity, which basically means you're buying half of the equity tranche, right? There were a lot of appeals, and eventually it did go away in the U.S. So it's no longer a rule in the U.S. It did stick in Europe. So European CLOs still are risk retention compliant.
Understood. Okay, so let's talk a little bit about how you manage the business. Let's start simple. What are the metrics you're looking at as you?
Credit risk. I mean, that's where we lose. That's where we make or break our investor track record. It's about defaults, right? The first loss to our equity. It's about how do you recover on those defaults, which makes a big difference and has been an interesting trend in our market with LMEs and more out of court restructurings. Whereas before, for most of my career, if you owned a loan and I owned a loan and it went into bankruptcy, we got the same recovery, right? The same risk. But now with more processes being out of court, one manager could get a much higher recovery depending on how they position themselves with the sponsor and what group they get into than another manager. And that's starting to have a huge impact on performance.
I follow what you're saying. I don't follow how one owner of the same bond is in one group versus the other and gets a better payout.
Yeah, so there are some famous examples of this over the last 10, 15 years, but it wasn't market precedent, right? So you've heard things like J. Crew maybe or CERTA, and that was some of this starting to happen in its nascency, but now it's standard market practice. So what happens, and I'm going to generalize here, is companies running into trouble, a group forms and they get to 51% of that loan, right? 51%, you could start to have amendment rights, right? You could start to change outcomes. And that group, usually advised by an advisor, may approach the company and say, hey, like, we know you're having a problem. We're willing to do X, Y, and Z for you, or we're willing to give you some more money to let you push out maturities. Or maybe it's the other way. Maybe the sponsor says, hey guys, you have a really loose document. The covenants are terrible, and I'm going to take assets away from you unless you give me something, right? And it could go in either direction. But the point is that if you're in that first group that cuts the deal, you could usually cut a different deal than Group B.
Amazing. Keeps the lawyers busy.
Very.
All right. Maybe talk about how you balance optimizing returns with and growing, and then staying within your structural and rating constructs.
Yeah, I mean, the most important thing is our performance, right? Because without performance, there is no future fundraising, there is no growth. And we've seen it. Like if you look at the top 10 CLO managers from before the financial crisis, probably half of them are gone and half of them are still here, right? But it all has to do with performance. So you think about avoiding defaults, managing defaults for better recoveries, or you get an active management, so buying and selling. If you underwrote a loan in 2019, you had no idea that COVID was happening. You had no idea that we were going to go through an inflationary period and that base rates were going to go from 0 to almost 5.5%. And then we were going to go through commodity issues with Ukraine. We would have the Iran war, like all of these things have
Tariffs.
changed. Thank you, tariffs. And being able to manage your portfolio through that, it's not just sitting on the shelf. Like you come in and you're able to buy and sell your portfolio every day. So actively managing it, not being, not allowing like investment thesis creep or analyst bias, like constantly testing whether you still want to own that loan or the credit risk has changed, I think really makes a difference in matter of performance. When you look at some of the data, you could see that managers that more actively manage their portfolio in CLOs will do better over a long period of time. I'm proud to say that we at Carlyle, when you look at the top 40 managers, so the really large managers, we've had the best total return on a 1 year and 3 year basis, and the sixth best for 5 years, right? Just showing that active management, managing default risk, and credit risk in the portfolio matters to performance.
Very interesting. My brain's turning in many directions right now, and some of the issues that we're dealing with in the direct lending part of the world right now show some of the limitations of the new product structures by not being able to actively manage. I get that. Okay. Can you talk about the OC test, the overcollateralization test, and how that protects people?
Yeah, so basically, very simply, what overcollateralization test is saying is you need to have more collateral than the money you borrowed. That's the overcollateralization. And you need a lot more collateral than the money that you borrowed at the AAA level. That's why they're rated AAA, because they're so overcollateralized, and less all the way down to the double B. And now, just to give you an example, the typical double B is issued with 108% over collateralization, meaning like 100% you would just be covered, but you have 108%, and that only moves up and up and up, to get to AAA.
Got it. Okay, that's helpful. Last one on the good stuff. What does good performance look like? I'm gonna go with very little credit losses.
I think, yeah, we call them par losses. Par is what matters in CLOs. It's the same thing as credit losses. So managing the downside is usually important. I think arbitrage is also important, right? Because that's what gives you your cash on cash. You could get arbitrage in two ways. One is you could price your debt at tighter levels. That's one thing that I find really interesting, right? Because as a tier one manager, a large manager, you're pricing your debt somewhere between 5 and 20 basis points tighter, depending on the market. Like great markets, it's only 5. Harder markets, no one wants to do a smaller manager, right? But that means that you, large manager, and you, small manager, could have the same exact portfolio, so the same exact credit risk, but get somewhere between 0.5% to 2% higher IRRs just because you're pricing your debt tighter, right? So,
Wow.
So there's that part, which is really important, and then there's the asset side. And I think what our market has been trained in is that not to reach for risk for that spread. It's better to avoid the credit losses, have more of a market type of spread level, and protect the downside, get your liabilities pricing tighter without taking more risk, right? And that's the way you can produce the returns.
I would imagine that that's exactly what your investors want you to do. Okay. Now let's talk about the risk side. We'll start out with investors. What are they looking at? What are they monitoring? What are they asking you about in terms of their biggest risks?
Yeah, so they're going to look at par loss. I think one of the most telling metrics for risk, which isn't actually reported in our trustee reports or anyone's trustee reports, but because the CLO market's so transparent, you get 200 pages on every CLO every month, what they own, what industry concentration, what the ratings are, where the prices are. Price bucketing matters. Like that's a really good indication on the risk in the portfolio. So the percentage of loans under 70, under 80, under 90, over par, will give you a really good insight versus just looking at rating agencies. Of course, you could look at the average rating in the portfolio or the percent of the portfolio that's triple C's, but I think the prices move first, and that's a better indication of risk.
Interesting. You talked about recovery rates a couple of times. What are the recovery rates in general over time?
So everyone we like to say that as an industry, historical recovery rates were between 60 and 70 cents. That's factual, but that's over a very long period of time. And more recently, recovery rates have been much lower than that. on an LTM basis, the average recovery rate for a loan, including LMEs, because now I look at defaults as in court and out of court because so much is happening out of court. The average recovery rate is in the low 40s today. I'd say because of the dynamic that we were talking about earlier, our average recovery rate is in the low 70s in the LTM basis. So think about the
You're
difference.
actively getting in the good group.
we're trying, yes.
You want to take a second and just explain LMEs because I'm not sure everyone will know.
Yeah, it stands for liability management exercises, and it really is some type of loss-taking event. Usually you take your loss in bankruptcy. You file for bankruptcy, you get some debt back, you own the equity in the company, you take a loss. Bad investment. Now, because loan documents have gotten so loose, there's more to do without actually filing a company. And that's where all this financial engineering comes in, the different groups come in. The sponsors have immense value in this, right? You think about, traditionally, you are not supposed to take $1 loss as a creditor until the equity is wiped out.
Right.
That's flipped. Now, with these LMEs or liability management exercises, sponsors can come in and protect their equity value by saying, hey, lender, I'm going to start to strip assets from you unless you push out my maturity, haircut your debt, maybe kick in some extra cash, whatever they want to fix the problem. And that's become commonplace over the last 2.5 years. I think about the loan market, a lot of people probably have heard about us going covenant light, right? Like we used to have covenants before the financial crisis, no covenants. That was a sea change for our market. Mm-hmm. This is the second sea change in my career, which are these LMEs.
That sounds like tough relationship management exercise. We might have to rename it. Okay, how about for you, for the manager? Where's the risk lie for the CLO manager?
I mean, it's pretty aligned with our investors. If we take excess risk, no one's going to want to invest with us. In fact, some of our subordinated fees could be shut off. If you think about fees in a CLO, a manager has senior fees and subordinate fees, and you pay the interest in the middle. So manager gets paid part of their fee, then you pay the interest on AAAs all the way down to BBs, and the manager, if they're doing a good job, gets the rest of the fees, right? Or the rest of their stated fee, and then everything else goes to equity. If we took outsized risk, or any manager takes outsized risk, we start to have worse over-collateralization ratios, which you asked about before. We start to breach those tests. Mm-hmm. We could start to defer, not lose. You have a chance to earn them back, but defer management fees. I'd say that some managers have really gotten themselves in trouble. It's not the majority of the market. It's not even like a high percentage of the market. Like, for example, Carlyle's always gotten their fees. But that's a real risk. You take outsized credit losses, not only is your investor going to suffer, but the manager's going to suffer.
Understood. There's probably been 5 or 6 recessions called in the last 17 years with none of them happening, but people right now are a heightened sense of awareness of reinvestment risk and whether or not companies can refinance themselves at reasonable rates. Where does reinvestment risks fit in for how you manage the portfolio?
Yeah, it's a real risk depending on where your debt is trading. I'd say that if we look at our portfolios or just the market since Iran, over 60% of loans are trading over par. Before that, now it's about it's probably around 20% right now. Those loans are very easily refinanceable, right? They're already trading over par. What we're seeing now is that even for a company with no software risk and no commodity risk, they're still paying about an extra 50 basis points over the last month or so to get their loan maturity pushed out. So I actually think a big trend of what we're going to see this year is more of the 2028 maturities coming to market. Why didn't they deal with it already? Maybe they thought they were going to IPO, or there was an M&A transaction, or they just thought the market would always be open. But I think with the volatility, we're going to see anyone that can refinance with a 2028 maturity come and pay up to do that a little bit, somewhere between, it's hard to say, 25 to 75 basis points, depending on what industry and the credit quality. And then if you look at the 28 maturities, which is about 20% of the market, about a third of them trade under 80.
Third.
That's a third of 20%,
Mm-hmm.
right? And I think that's the forward 2 years of LMEs.
Mm-hmm. Pretty efficient market if that's the case. Okay. Biggest mistake a CLO manager can make? Just reaching for yield?
That, but also position sizing. Like you could make mistakes in a CLO because they're so highly diversified. You'll have 200 to 300 credits in a CLO, right? You have maximums that you can put on any credit in any industry. They're highly diversified by issuer and industry. And that's the way it's supposed to work. But you've seen managers get into a lot of trouble when they've put outsized positions in risky credits. And so you could have a risky credit, but it's 10 basis points of your portfolio. Your CLO is probably going to be okay. When it's 75 basis points or 100 basis points of your portfolio, it's not.
Okay. All right. Let's talk maybe about what drives pricing and returns for CLOs, spreads, liability costs. You mentioned all, just package it together.
Yeah, it's so until February, we were seeing some of the tightest levels on liability costs and CLOs, and that's not just our market, right? We were seeing the tightest levels for IG for high yield, right? Like we were in a super tight spread environment. That has widened a little bit, but I'd say in a historical context, we're still at least at the AAA level, which is the majority of the CLO financing. It's still at pretty tight levels. And what you start to see is more demand for resets when you're at these tight levels. So last year, I believe, was a record-breaking year for both new issue CLOs and reset CLOs. And part of that was driven by the tight liability spreads available.
As a manager, do you have the ability to either go up quality or hoard cash if you think spreads is just too tight?
It's really hard to run with cash because we're levered, right? Because we're an arbitrage vehicle where we're paying interest, we need to be receiving interest. So on the margin, yes, like we were probably running one of our highest cash balances going into February because we were dealing with so many repricings and we were giving paper back on some of them. But you could do that for a couple percentage points of your portfolio. It's not like you could make the call to go to 10% cash.
Okay. How do arbitrage conditions or volatility play a role into your process?
We love volatility. I mean, it never feels good, right? But that's when you're actually able to move your portfolio around. And I think that's when we make our best calls. So when 60% of the loan market is trading over par, it's really hard to find those credit reduction swaps because the market's pretty efficient and like the really troubled credits trading under 80, and there's probably only like 3% of them there, and then everything else trading around par, and you can't move between them without taking those losses. When you start to see volatility like we've had for the last couple months or like we had during tariffs, you could start to make the credit calls and look at moving because the market's sloppy, right? And mispricing individual risk. And I'd say that's when you see our highest trading volumes. For example, during tariffs last April, we traded over $3 billion in the U.S. of loans, and that was just moving things around. And we traded close to $2 billion when Iran started in April.
Okay. Active management. This might sound like a silly question, but so how do clients measure performance?
Oh, there's so many stats. I mean, every single bank that's out there puts out data on us every week, on us and our 140 competitors. So you could sort it by triple C's, by price buckets, by total return. And every investor has their own way of looking at it, right? They have the models that they built that weight par build is the most important, or rate coupon is the most important. But what's amazing about our market is just how transparent it is, and how you could have, we could have 100 CLOs outstanding. We could have 140 competitors that each have a lot of CLOs outstanding, and there's a 200-page report with the data coming out on each one of our competitors' CLOs and our CLOs every month for an investor to analyze.
Amazing. All right, let's talk about growth, issuance, market dynamics. How much growth has this market seen? How do you think about it? You pick the last decade, whatever you want.
So it had an immense growth from after the financial crisis to, let's say, 2021. The market probably tripled in size at that point. And then an interesting dynamic happened. We've talked about resets. So a lot of CLOs just like were resetting. And then 2022 and 2023 happens and spreads blow out. No one wants to reset, right? So, and there were other opportunities in the market to earn equity-like returns. So the demand for CLO equity went down at the same time where you were having less resets. And so the market sort of stagnated, right? It just was flattish. And then coming out into 2024 and 2025, as spreads started to compress again, you started to see a backlog of resets hit the market. And that's why it's like the market made up for 2 years of not resetting by resetting a lot of CLOs in 2024 and 2025, which pushes management fee streams out and sort of stabilizes AUM. And then you had the two biggest issuance years ever in 2024 and 2025. But with all of that, it's still just a slow growth the last couple of years because you had all of those deals that didn't reset for 2 years. You had runoff from those deals as, they were post-reinvestment period. The AAAs are getting paid down. And now our market looks like it's poised to grow again. But I would say it's probably mid to high single digit type of growth.
It's interesting. As you go through that, I'm thinking to myself, are the perception or reality stresses in the direct lending market going to provide any tailwind for for you guys?
I think we probably see more product come to our market out of direct lending, or maybe a better way to say that is when a sponsor is looking to finance their acquisition, they may want to come to the BSL market versus the direct lending market for a period of time. Look, the direct lending market had phenomenal growth. For a long time, if you were a company, you only got to choose between, if you're below investment grade company, you only got to choose between high yield and the BSL market. And then you had this third market to choose from, which was great because when the banks pulled back in 22 and 23 and they weren't underwriting, which is how the flow comes to my market, direct lending was able to step in and stabilize things. And I think that not to that extent, but I think you may see BSL lenders step in to stabilize things as flows are coming out of direct lending.
Mm-hmm. What about strong M&A environment or lots of loans trading below par? Like what type of environments influence your world?
All of them. So we like to see M&A in our market. It's been slowed the last couple of years with base rates being higher, and I'd say just a lot more headline risk that you see M&A in fits and starts because of it. But there has been a lack of, I'd say, organic new supply in the BSL market. That led to a lot of repricings in loans. The average loan portfolio lost close to 70 basis points over the last 2.5 years of spread. That's meaningful. Why? Because there's demand for loans, but there was no real new supply coming. We saw a decent amount of supply in the first quarter of this year, but it does feel like that dries up a little bit now. Now, your point on the primary versus secondary, or what drives that, secondary still is mostly trading over par or below par. So you have the opportunity to create portfolios in the secondary without buying them over par.
Interesting. Okay. I can't believe we made it this far. Last week I had a lot of my banks report earnings, and all is good in the world. Nothing to worry about. So there's your answer. But how do you see credit through your lens? You have all this information at your fingertips, 100 CLOs, a couple hundred positions each.
Yeah. So we lend to over 550 companies in the U.S., over 200 in Europe, just in our liquid business. And we get data on each one of them. So a few interesting things. I'd say growth is slowing, but there's still growth. So if we look at our fourth quarter data, we see mid-single-digit growth in EBITDA and sales on average across our portfolio, both in U.S. and Europe, which is interesting, right? They're both doing that. Interest coverage has been going up. That makes sense because I just said there's been 70 basis points of repricing, and then rates have come down, so we're seeing better coverage for interest. And this one gets me. We're seeing more of our companies produce cash flow than we have in a really long time. And if we look at like 2021, where we're probably seeing the highest growth rates out of our companies and the highest percentage of our companies growing. I don't know, half of them to 60% of them were producing cash. That was it. Why? Because they were investing in growth. They were over hiring, probably spending on CapEx. Everyone was growing. There was a lot of projects to invest in. And then you get hit with higher rates and all the macroeconomic uncertainty. And management teams are really good at focusing on what matters, which is producing cash in times of uncertainty.
Okay. So bottom line, what kind of default rates are you seeing now? I know we had the LME issue, but in general, what kind of default rates are you seeing now? And what are your projections where we sit?
So looking at it with LMEs, during COVID, defaults spiked to 4.5% in the liquid market. We got to 4.3% in the fourth quarter of 24, including LMEs. No one was talking about it. It was a default cycle that our companies is going through. What caused the cycle was a lot of these 2021 LBOs that the growth expectations didn't come to fruition, and then no one forecasted rates going to where they did. And when those two things happened and it wasn't a good company, they started to go through restructuring. We've been coming off of that since then. We're in the, it's not like we're back down to zero, but we're back down to about 3%. So we came off that peak. I think we probably still hover in that 3% range. Maybe we go up a little bit. I don't know that we go back to that spike, that peak that we had in the fourth quarter of 24. But I'd say on average, the loan market runs a little over 2% defaults a year in 25 plus years. I expect us to continue to run a little higher than that.
What's interesting about those numbers is if we're hanging in 3, if we had a recent peak in 4.3,
yeah,
and if we're even in the middle of the range, it sounded from your previous comments that AAA won't notice. They get all their money. AA gets all their money. Single A gets all their money. Where does anybody in the structure feel any of that, even if we're hanging in the 4 handle?
It's really the equity, right? It's about manager selection, right? So our default rate is LTM 1.8%, right? So we're running well under the average. If you have a manager that's running at 3-4%, there's going to be ones that are over the average too. And that's where manager selection becomes really important, because someone's going to take those defaults.
That was a recent period, right? Just, a handful of quarters ago.
Yep.
Does the investor base, your clients out there, do they have access to the information of who does better during that downturn, who has the ability to do workouts?
They do, and not only, and even if they didn't, which they all do, the banks are putting out reports on us every week, right? So all of the large banks are saying this manager's doing better, or this one burned par, and they have rankings for all these categories, and they'll send our investors spreadsheets to make it easy for them to rank. So it is fully transparent.
So it sounds like we talked through where the losses typically will show up. Given the loss rates that you just mentioned, it's almost always borne by equity and nobody else, and maybe once in a blue moon a little bit on
the little.
Yeah. How do you differentiate with the bulk of the dollars, meaning the AAA, AA, single A, right? If they're never having losses,
yeah, why do
it's
they
your
care?
cost of your cost of credit and all that stuff. How much differentiation is there, between your 140 competitors and you at the high level tranches?
There is, and I'd say it's driven by a couple of things, and I'll try to rank them. One is liquidity. So just like I want liquidity in my loans, most of our investors want liquidity in their AAA bonds. And so the more your bond, the bigger you are, the more you trade, that sort of gives you an advantage, because there's just some small managers that they're not a lot of buyers for. So you have less liquidity, right? They don't have, people have approved lists, and how many of the 140 names are you going to have approved?
Right.
You may have 30 or 40, right? So liquidity matters. Downgrade risk. Like if you think about AAA risk or AA or single A risk, it's not credit risk, but it's downgrade risk, right? Like if there's a lot of losses in portfolios, your AA bonds may be downgraded to single A, and no one wants that, right? There may be different capital charges, different buckets. You explain it to your boss, like you show up on stop loss reports. So downgrade risk matters, and that risk is real if a manager is underperforming, even in those asset classes. So I would, and then as you move down, price volatility risk. There's not a lot of price volatility risk higher up in the ratings, but let's say you own a double B and that manager is starting to really underperform. And even if you end up losing no money on that bond in the long run, but you're starting to worry, you're seeing the deterioration, that price of that bond is going to be falling, and your total return that year, you as a bond manager, is not going to look that good.
Understood. Okay, when you're putting together the portfolio, I want to talk about this, the Carlyle part of the conversation here. I want to talk about how you source loans, and that could be your own origination, and that could be a relationship with the banks. Like, talk about how when you're pitching business to investors, talk about how you're differentiated sourcing.
Yeah, so this is really different than the direct lending market, right? Like we don't originate. We're not allowed to originate. So the banks do all the originations, the large banks like JP Morgan, the BAMLs of the world, the cities, right? They're bringing us our product. Now, they'll usually come to large lenders that could write a big ticket for any transaction early and say, let's give you an early look on a transaction. Curious your thoughts on like if we're pricing it correctly, or like just, do you think this will go well in the market? Is this something you'd be interested in? So usually we're seeing transactions early, but we are seeing the same transactions that our peers are seeing, and we are not directly originating.
But you can put in for this much of a deal, and then your relationship with that underwriter changes over time, or are you making sure that you're balancing position sizes?
I think that really at least for a manager of our size, what the banks appreciate is candid feedback early on in the process. So it's not about doing all their deals. In fact, like we don't. It really is about the credit risk. When you think about our 10 times leverage structure, we're important enough they have to show us every transaction because we're one of the guys that could write, the large tickets. But being transparent, not retrading once you've said you're going to do something, and giving early feedback, I think allows them to think about how they build a book. And I think it's those relationships for many of us who have been growing up in the industry together, having that trust on feedback is really important.
And when you're running around marketing, how do you advertise? How do you show your performance? How do you talk about your performance?
So the good thing about us is that we've been around for so long. So I say you could look at us through multiple cycles. You could see how we did in the dot-com bubble, the financial crisis, COVID, and so on. And you could actually see how our deals are performing. You could see that our average IRRs are higher than the market. Our average defaults are lower than the market. So the risk-adjusted return looks attractive.
Looking forward, biggest opportunities for your CLO business for Carlyle?
Yeah, I believe there's more growth opportunities in CLOs. A year ago, I would say private credit CLOs. I actually think that will still happen, but maybe at a little bit of a lag now. If that private credit CLOs have generally been a financing trade, meaning like you already had the assets, but it was cheaper to finance those assets with a CLO structure than a bank facility. That wasn't incremental AUM you were raising. It was AUM that was just already there and being financed. If you look at the BSL market, that's every time you raise a CLO, that's additional AUM, that's additional management fees. And I think part of that business model is going to move over to direct lending over time, where today maybe that's 20% of direct lending is actually fee earning CLOs. I don't know where it goes, but I think it goes higher. And so I think when some of the noise around that asset class calms down, you may see a CLO opportunity emerge, a fee-paying CLO opportunity emerge in that market. My plug there very quickly would be that if you have the arbitrage on a traditional CLO maybe is 12%, something IRR. For a direct lending CLO, it's 18%. So I could see some of the traditional BSL buyers move in and create a bucket for that return.
I mean, I think it's the structure and being able to choose your own adventure is what to me is most interesting about
I
that.
agree. I totally agree.
Okay.
And then I think now that the market moved through a really difficult time when it couldn't reset, and so much of the market was post-reinvestment period, meaning in runoff. The market has fixed itself, meaning it's focused on resets for the last 2 years, stabilized the AUM for the market, and now that maybe only 10% of the market instead of 40% of the market is in runoff, that allows for growth again.
Okay. Speed bumps along the way. I'd love to get your State of the Union on what you're seeing on the software side. I mean, the range of potential outcomes that I hear from people has never been wider on anything. So
I agree.
Curious, maybe factual first of how wide have things widened out, and then just what do you think is going to happen?
Yeah. The range of outcomes is enormous right now, and it depends, for the industry, but also for the individual companies. If you look at the average price of the loan index today, it's around 95, a little over 95. The average price on the software loan index is 88. Like that, and that is the largest sector. It's not overwhelming, but it's about 13% of the loan market. So it is a large sector in the loan market. The average discount margin on a software loan is 830 basis points. That's telling you on average that's what a software company has to pay to get financed. That's high right now. Now, it's not exactly a fair comparison because there's a lot of loans that trade at 95 and then there's loans that trade under 80, right? And what I'd say is 95, 96 is the new par for software loans. And then you have a lot that were already struggling before AI that now have just really fallen to that below 80, which means we're talking LMEs over the next couple of years for those. What's interesting is we haven't seen, well, it's so new since the software sell-off, but we haven't seen any of these large performing software companies have to come back to the BSL market for refinancing. But there are a number of them with 2028 maturities, and I think we're going to start to see the playbook.
I was going to say, when wouldn't now be normal for a 28 maturity?
Absolutely, and you're not going to let your debt go current on your balance sheet, right? So those 28 maturities are probably going to have to be dealt with in the second half of this year, depending on when the maturities are. And I think there is a playbook for them. For the software loans that were trading at par in January that now trade at 96. Those are going to be figured out.
Yeah. I think in blunt terms, if you tell me 96 the new par, that's 4% on a position. You get your arms around that. What that means for the equity, bigger implications. All right. How about last thing on software?
Yeah.
We haven't seen any real losses,
No,
right? This is spread widening and market pricing.
So if you look at if we segment our portfolio data, one of our fastest growing industries is still software, right? Like our companies are still growing high single digits in the fourth quarter as we're getting data.
How about the lowest priced bonds?
No, they are not. They're priced appropriately. Now, none of those are falling 10%, by the way, right? They're maybe shrinking a couple percentage a quarter, right? We're not talking about any of our companies down 20% or anything like that. But that's backwards looking. We have to be realistic about what this means, and it means to us, or our projections are that software companies have to spend more on R&D, right? They have to spend more on their AI solution to protect their incumbency in their clients where they currently sit, and there should be more competition, which means pricing should come down. So sales should slow, margins should compress a little bit. Does it mean that everyone's broken? No.
Hopefully you still get paid back.
Yeah.
How about the way you at Carlyle are using AI to help you do what you do?
Yeah, so it's been pretty eye-opening. Carlyle has an AI team that really has sat in the private equity group for a few years and has been working on how to make Carlyle's PE companies, how to incorporate AI into Carlyle's PE companies. And that's sort of opened up to the rest of us more recently. we have I've been blown away with what they've been able to produce just for my team on my 550 credits in the US. I have an AI dashboard now that they've built. They have risk rated all of my AI risks for my companies. At first I said, should I just send you my software companies? And they said, no, send us everything. Within a week, they sent me back this dashboard. I've never seen anything like it. I could click through each industry, each risk category, each company, full write-ups. That gets back to like the resource question that you asked in the beginning. Having these groups that sit inside of a large manager like we are that can be dedicated to building out risk systems for us now incorporating AI is pretty amazing. I've only had it for about a month now. And now every time I'm on an investor call, I say, can I share my screen? I want to show this to you, because at the end of the call, everyone tells me they've never seen anything like that before.
That's interesting. I want to see that too.
Happy to walk you through.
How about last couple here? What, if anything, can structurally change the CLO market over the next 3-5 years?
Regulation, of course, but we're not anticipating anything. But just like risk retention changed the market, actually for the good. Didn't feel like it at the time, but forced us to get more creative in how we raise money. That's always a risk. And then really, if we do live in this outsized, if we have more defaults, if we go through a cycle, we could see fundraising slow down.
Yeah,
right.
Normal.
So I think that's normal. But overall, the CLO structure continues to show resiliency. New investors come into the asset class because of it. It's no longer sort of a niche product that it once was, 15 years ago. So CLOs seem to figure out a way to keep on going.
Yeah. You talked about risk retention come and go in terms of the rules in the U.S. You mentioned earlier the capital requirement on, I forget
Europe,
AAA, AA, single A is all the same.
Oh, for insurance
like
companies.
Yes, for insurance companies. There's some talk about that. Is that material if that does change?
I think so. I think there's a couple of things now that we're talking about regulation where it could make it easier for insurance companies and then some European investors to buy AAAs going forward.
Okay. Last one. If you were going to highlight one misunderstood aspect of CLO market, what do you think?
CLOs did not cause the financial crisis. Just because it's a C and an O, those are CDOs, those are mortgage bonds. They were all tied to one asset class, and we are highly diversified by industry and by issuer. And I feel like we get a bad rap oftentimes that we don't deserve.
Well, I think you should send them a copy of this podcast, which will be available wherever you get your podcast, because this was an excellent discussion. I learned a lot. I really appreciate you doing this, Lauren.
No, I appreciate it. Thanks so much for having me.
Thank you.
You've been listening to Evercore's Flow of Funds with your host, Glenn Schorr. Be sure to subscribe wherever you get your podcasts. The views and opinions expressed on this program are for informational purposes only and do not constitute investment advice or a recommendation to buy or sell any securities. This program is brought to you by Evercore Group, LLC, a member of FINRA and SIPC. To learn more about Evercore's research and investment banking businesses, visit evercore.com. Thank you for listening.